Welcome back everybody. So this video will be slightly different where I'll be reacting to a podcast or an interview series between Amit and Joseph Carlson. So I believe many of you do know who Joseph Carlson is because he's one of the bigger YouTubers out there in the space as well. And he personally is invested in Alibaba. But recently though, I believe that his confidence in Alibaba as an investment is slightly shaken, probably because of a lot of the Chinese fears, delisting, and the list goes on. And even though it's an hour-long conversation, I'll just be reacting to the 8 to 10 minutes Alibaba clip where Joseph Carlson really dived deeper into Alibaba, probably pen down some thoughts, and give you my live reaction, as this is my first time looking at this interview. So do pardon me if I'm a little bit slow. And yeah, this is my first time watching this interview as well. So let's get right into it.
They're not bad companies, by the way. Zoom and Teladoc are great companies. The point is, they're not as innovative as a lot of companies out there.
Right. You talked about companies that you like to invest in that are simple and predictable. One of the companies, I think
Not sponsored by Coke, by the way. But yeah, let's get right into the interview.
Biggest companies in the world, that to me is the most simplest and predictable in terms of predicting its growth and revenue, is Alibaba. It's a very simple business at the end of the day. It's not that complex, a lot of technology involved, but at the end of the day, we know what the story of Alibaba could be, and investors had faith in it about 2 years ago. But as a result of the past 2 years and what's been going on with the Chinese government, there have been a lot of headwinds. So can you tell me your relationship with Baba? When did you start buying it? And has your narrative or thesis changed? And is it a buy right now for you going forward?
No, I think, so how I got into it is like, I think most other investors that bought into it. Basically, if you just do fundamental due diligence on Alibaba and break down the company, it's one of the best companies in the world based off its revenue, free cash flow profile, market position, the assets that it has. Ant Financial was going to IPO and be a massive financial that would have a lot of returns. And basically everything that could go wrong went wrong with the investment. So the Ant Financial blew up. That's something that just value destroyed, like a ton of value. It was going to be the biggest IPO in the world, and it blew up because the Chinese government didn't like what Jack Ma said. So
Okay, that's something that I slightly disagree. Okay, so let's first discuss about the fundamentals and doing due diligence on Alibaba as a company. If you were to exclude the Chinese government out of this entire picture, I do agree. It's probably not the best. I also wouldn't even quantify Alibaba as one of the best in the world. I think likewise, where Charlie Munger actually shared his opinions and sentiments on Alibaba, arguably, if you're to compare the economic mode and the competitive advantage of Alibaba as a company, it's not as strong and it's not as entrenched as a lot of all the other companies out there, comparison to other big techs like Apple, Google, Facebook, Amazon. I think it pales in comparison, especially when the TAM, which is the total addressable market, is significantly lower, and the trust in Chinese companies are also brought down by many notches. So I disagree on that part about it being one of the best in the world. But that being said, I do sort of agree that hey, there are a lot of things that went wrong to Chinese investments and the entire basket of Chinese equities. Not only specific to Alibaba, even companies like Tencent, Meituan, most of them all got their good take and a good share of headlines on Bloomberg, Reuters, you name it, we have it. With Tencent being embroiled with all the cap in gaming, and even Meituan, where they have to cap their take rate in order to help all these different small businesses, especially when the economy is in turmoil. But the only thing that I cannot agree with is really this impression that the CCP really just dislikes a lot of all these entrepreneurs, and just because of Jack Ma's fiery speech, that's why they started the crackdown. I largely disagree. I believe that largely speaking, this crackdown was overdue, and there were really a lot of things that they had to iron out, especially in the last 5 years of expansion, where they did a lot of things by left, and the government really needed to set the record straight. So yeah, I believe that even with or without Jack Ma's speech, this crackdown was kind of overdue from the Chinese government's perspective.
he mouthed off to government officials. That was kind of like strike one. Then you had right afterwards, an entire, you could overlay a stock price chart of all of this going on, and it's just going down the entire time. But then the second thing happens, which China decides it's time to regulate, right? Not good when you make an investment in a company and then the government, which is a dictatorship, all of a sudden decides they're going to regulate companies and implement a bunch of different rules. So they're like delisting companies in the US. They're simply, I don't even know what they did. They just like banished companies that did tutoring and online tutoring and schooling. They went to Tencent and said, hey,
Okay, I think it's true. I think I did explain this entire idea about China government deciding to regulate. I think it's something that is quite common. I believe for old-time viewers, you know that I always like to pull out this chart where the regulatory tightening and the regulatory cycle in China operates like the stock market. There are peaks of regulatory tightening and there are also troughs where there is looser regulations and allowing for all these companies to flourish and even prosper. That being said, it's true, they did implement a new bunch of rules and if you really look into it, there are three core focuses. One is on data privacy, number two, it's on algorithm recommendations, and last but not least is definitely anti-competition. So then you start talking about delisting of companies. As far as I know and as far as I understand, the only one that really got into the crosshair of the Chinese government specifically, it's really Didi Global. And I don't wish to belabor the point, but I believe for those of you who actually do follow Didi, the Chinese government essentially told them to stay in line and wait for the different audit results and whether they are of strategic importance. But they decided to just not heed the government's advice and perspective. So I can't really blame them for that. But other than that, the rest of the other delisting concerns and scares, I like to reiterate, and I feel like I'm a broken recorder. I don't know how many times I've repeated it. The ball is entirely in the SEC's court, which is the Securities Exchange Commission. The decision ultimately lies on the US regulators and not on the Chinese regulators. So we'll see how things are playing. Everything is still fluid, but we'll see how things transpire from here on.
kids can only play 2 hours of video games a day, right? Or they can only watch like TikTok for 2 hours a day or something.
Right.
They're doing all these crazy regulations. And of course, that's not good in investors as an investment thesis. So that happened. Stock price continues to fall. And that was kind of the big news. And I'm like, all right, well, the story is deteriorating here. Like, I'm just acknowledging it. Like, the story's kind of falling apart here. It's one thing after another. And then it continues. We have a war breakout in Europe between Russia and Ukraine. And wouldn't you know, that happens where Russia is more of a friend to China than the US. They're kind of more friends with each other than the US. And obviously, there was already kind of issues in China between the US with COVID and their policy. They shut everything down and whatnot. So it basically evolved from one macro concern of just like a good company, but it's in China. My thought process at the time was we do a lot of business in China anyways. Like Tesla has, I don't know, like 20% of their sales in China. Disney's in there, Nike's in there. Lots of companies are in China. So I didn't think it was like an end all. But with the geopolitical risks that have risen between Russia invading Ukraine now, it's made investors even more cautious. They don't want to invest outside of the US. So I look at it as just compounding concerns driving down the valuation. I think it does affect the story. I wouldn't promote investing in China right now. I just think the risks they've compounded way too much. There's way too much
Have you
uncertainty.
trimmed your
Okay, let me jump in before Amit actually continues the conversation. So I have to acknowledge a few things that Joseph Carlson actually put forth. It's true, I think story deterioration, it's reflective of the stock price. If there really isn't a problem with the story, or if there really isn't a problem with the company, investors, or I believe there are a lot of the smart investors and smart money out there, which usually represents institutional money, they wouldn't be exiting their position. But because of the increased heightened tension, especially when you add in geopolitical risk, you add in Russia, Ukraine with China and US, and everything just compounds at an insane amount of speed, there you have it. It's a perfect storm for Alibaba. But that being said, I think the funny thing is, I don't think Russia is friendly to China. I'm a little bit out of my depth here, but they're technically not even allies. They're just trading partners. They're on friendly terms, I'm sure. China doesn't listen to the US bidding, they didn't join in the sanctions onto Russia, but that doesn't mean that they're allies. I'm quite sure both countries, both China and Russia, is wary of each other. Even though on the surface, they seem like good partners and good allies, I fundamentally don't believe that they will help out each other in the event that a war actually do break out, or even a World War III. And touch wood, let's hope something like that will never happen. But that being said, it's true. I think my initial investment thesis, one core part of it was really this idea of having exposure to China. A lot of all the US big conglomerates are also prevalent in China itself. You have your Apple, your Tesla, your Disney, your Walmart, just to name a few. And in this instance, China, if you're to look at it, over the years have strategically pivoted into the entire world economy, and because of globalization, they essentially entrench themselves deeply into the entire global ecosystem. So that's something that I'm extremely comfortable as well, because that being said means that if you were to start playing with sanctions and start ostracizing all these different countries, there are huge ramifications down the line. So that was exactly something that I was thinking about as well when I was a little bit skeptical about having a full-fledged economic war with China between the China-US geopolitical tension. And on the last part about investors being extremely cautious, I think it's evident in the valuation. There are immense selling pressure, and you don't know exactly who are all these people that are selling. But rather than operating on a pompous assumption that everybody is wrong, while I'm the only one that is right, and I'm the one buying into China, I think there are merits into understanding why people are understandably skeptical and understandably cautious. But if you to project forward, because the stock market is always forward-looking, where do you think China will be in the next 10, 15, 20 years? I think it's up for you to decide, and you make your own decision and your own judgment call. And more importantly, the thing that you have to make an even more important decision is to smash that freaking like button, of course. So let's get back into the interview.
Position in Baba, or are you just holding and waiting?
I've not trimmed. I've just held it. I just held it.
So I mean, a part of you believes that it'll come back.
Yeah, I do. It's just so risky. Like if you're doing it, it's one of these things where it's like, even when I was first investing in Alibaba in China, I was like, no more than 10%. Like I'm not doing that more than 10% of my portfolio because it has country risk. Like They could just shut it down or delist it and I'd lose money. So I can't go all in like I could like an Amazon or something that just doesn't have those type of risks. But now the risks have just gone so out of control that even though the fundamentals might perform well, the price moves up because of supply and demand. People want to own the company. And so unless China becomes a more attractive place for investors to invest, I just think it's going to be a difficult road. But right now, I feel like the valuation of Alibaba has fallen to levels to almost reflect that risk. So if it hadn't fallen quite as much, I'd probably be taking some out. But the fact that the price has already declined so much, I'm like, it's still at a point where I think I'm just going to hold on to it.
Now, you're not one of those investors that's like solidly in the value investing Munger Buffett camp. But yeah, Munger did put in $72 million in December into Alibaba. Does that give you any reassurance? And he put, I think when it was a 120.
Yeah.
Does that give you any reassurance that like, look, Munger's doing? I mean, Munger can afford to take that loss, but if he's doing it, like he must know something about the company.
Yeah, I look at it this way. It is a positive. He's very positive on China in terms of, he highlights some good points. Like they're growing their economy like crazy. Like you look at the skylines and they have big buildings now and they have big cities. Before it was little. It wasn't as quite industrialized. Like they're growing their economy rapidly. We do a ton of business with them. I think that China and the US, I look all at incentives. Like we have incentive to work with each other, even though they're a dictatorship, even though we're free market, they still want to grow their economy. And the US has a lot of money that we can help do that with business, right? So I look at it from the incentive that they're not going to want to destroy their biggest businesses. Like that just doesn't make sense. They're not going to want to crush.
It doesn't make sense at all.
Yep. So that incentive plus Charlie Munger saying, "I'm putting my money in it." At a time it was kind of like, the people scared of this are silly, right? Like buy when other people are being fearful. That's the place to buy. But like you look at their history, Buffett's been wrong before. Charlie Munger's been wrong before. If you look at, they made many failed investments, but if it turns out it's a good investment, they make a lot of money. So I'm not going to go all in on it. Even if Charlie Munger does, even if another big name investor does, I will limit my risk with it because I can't have my long-term portfolio completely determined based off of what China does. I just am not willing to do it.
Okay, I think Joseph actually point out quite a few good points here. Firstly, I have to give him credit about him understanding and trying to do his due diligence and really expressing a very responsible way of investing. I think that's one. And second point, I think he did point out something that was quite sharp as well about fundamentals going well and price not even coming back. Because like we all know, the stock market is essentially a demand and supply at scale. It's just a huge amount of people coming to an exchange and behind every stock ticker symbol, even though we know that there is a real company operating, there are margins, there are profits, there are revenues, people still trade based on momentums and trade on emotions, and short-term price movements are fundamentally driven just based off demand and supply, just simple law of demand and law of supply. And even though if fundamentals go well, if the entire environment surrounding Chinese equities or Chinese stocks still suck, then your price is not going to recover, or because there is no huge money or there are not enough volume coming in to buy that stock. So in the short term, of course, I do share similar sentiments. If the broader market sentiments still look at China with a huge discounting lens, then regardless of how well Alibaba performed in the coming year or so, it doesn't matter because people just don't want to touch China. But in the long term though, I thought we always like to talk about investing for the long term and you're willing to hold a company for 5 or 10 years. But whenever we are embroiled in so much drama and so much turmoil, we always forget about the timeline that we are operating with, and that's the assumption that we have to give when we are investing in the market. Short term, nobody can predict the price movements, but in the long term, technically speaking, valuations should reflect fundamentals. Next, Joseph also talked about limiting his exposure to China to not more than 10%. I think that's definitely responsible advice, but of course, none of this is financial advice on the internet. I'm currently quote-unquote all in because on an absolute level, I know that my portfolio is not extremely incredible or extremely huge. And based on my own projection of my earning capacity and my earning power, after I graduate from university, I probably can earn back my entire portfolio maybe in 1 to 2 years time. But if you to compare to Joseph Carlson, he definitely do have his own fair share of skepticism, and he definitely have to hedge his downside. Because from what I recall, he has a portfolio of at least 300, 400,000. And even 10% of that is in the north of 30 to 40,000. And that's my entire portfolio value in that case. So if you compare on an absolute front, it's probably around the same exposure, but maybe in a percentage level, really you have to risk adjust based on your own personal risk profile and your own financial circumstances. At least when you come to the internet, at least on the YouTube platform itself, just acknowledge the merits of different arguments and how people put forth their viewpoints rather than really come in to see, hey, is there a new stock tip this week or this month and what stocks should I buy? Really try to scrutinize a lot of the investment theses and even including what I said, and look at what the different creators have to offer in terms of what they say, rather than just following them blindly. And the last part, I think it's a very interesting discussion about Munger being so positive on China. Likewise, if you're not positive on China, I'm not too sure why you're invested in Chinese equities in the first place, because you definitely do think that they have immense amount of potential in order for you to put money in them, right? But that being said, I'm actually standing on Joseph's side about this entire incentive structure and why China and the US continues doing business and why they're inherently motivated to keep this going. And more importantly though, I think I'll be releasing a separate video on why I'm comfortable with this entire China risk and investing into Alibaba. And that should explain and that should provide you with the entire backdrop on why am I so bullish about Alibaba and why a lot of all these so-called risks don't really affect my investment thesis. And to end off this entire video, there was this very interesting investing quote that came out from this 8 to 10 minute clip. Buy when people are fearful and sell when people are greedy. In good times, it's easy to give investing advice, but when everybody is fearful, nobody seems to be buying. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!